All right. Good afternoon, everyone. This is Joe Bicella, Director of Client Success here at Chaikin Analytics, and I'd like to welcome you to our presentation of the secret of finding winning trades in earnings season. Presenting today is Marc Chaikin, founder and CEO of Chaikin Analytics. Now, as a reminder, this webinar is being recorded, and a copy will be sent to everyone who has registered today. Please submit your questions throughout the session using the Zoom Q&A window, which you can access in the upper left-hand corner of your screen. Now, to get us started, we would like to welcome to the webinar founding editor of Power Profit Trades and Money Calendar Alert, Tom Gentile. Tom, take it away.
Thank you, Joe. Hey, everybody. Welcome. Welcome to all my Power Profit Trade readers. Glad to have you guys with us for what I think is going to be a very, very exciting webinar. You know, Alcoa started off today's Q3 earnings session, and or might I say the market reaction to our Alcoa's earnings started off the Q3 section. This is going to be what I think is, but between Q3 and the upcoming election, which is going to happen next month, I think this is going to be probably one of the most exciting earnings quarters, especially this year, but even in the last couple of years. And I could not think of a better person to usher in the Q3 earnings with me and all of you here on the webinar than our guest, Marc Chaikin. And before I introduce Marc, let's go ahead and play a short video. So, Joe, can you cue that video?
85% fundamental, 15% technical. And I created the model because self-directed investors didn't really have the tools and the discipline to successfully manage their own money.
And that's created by famous analyst and entrepreneur Marc Chaikin.
I'm a big fan of Marc Chaikin, though, so it makes me nervous, Scott, because I like his metrics of looking at the market.
Marc Chaikin.
Marc Chaikin.
An expert known on Wall Street for developing computerized stock selection models.
Joining us is Marc Chaikin. He is the founder of Chaikin Stock Research. Mr. Chaikin, welcome.
And folks, let me welcome stock market expert Marc Chaikin. Marc, how you doing?
I'm great, Tom. How are you?
Great. Glad to have you talking to my Power Profit traders here once again.
Well, it's very exciting to be here. We've done this twice, and we've really made an impact on the Power Profit traders, and they're now, many of them, part of the Chaikin Analytics community. So it's an absolute pleasure to share some knowledge, and I'm just fiddling getting my PowerPoint up and running here.
That's fine. You know, it's amazing that, you know, this is, I think what's going to happen is I think we've got a big earnings quarter coming in this season, because there may be more than the surprise we saw that moved the markets today, but there may be a lot of surprises coming in. And then, of course, we've got that horse race that happens, next month.
Heck of a horse race. The horses are shooting at each other. This is not the Kentucky Derby.
It is. Hey, before I turn this over to you, I got to tell you this. So we're in front of the, we're watching the debate Sunday night. And I got to tell you, I mean, nothing is bringing families together like these debates. I mean, it really is must-see TV. If you thought reality shows were something, this is on a whole new level. I don't know if your family's, getting together to watch it, but mine, our neighbors, I mean, this seems to be the water cooler talk the following morning.
It is here in Philadelphia, and I suspect that's true all over the world. So why don't we get started here and show the folks how we can find winning trades during earnings season. And I know Tom's going to jump in at a few points during the webinar, so please stay with us. And again, thank you for the opportunity, Tom.
Absolutely.
So in this afternoon's webinar, you're going to find out how to pick winning earnings trades. Very important, because earnings season equals opportunity in my view. So 5 points we're going to cover: how to find bullish and bearish stocks with the Chaikin Power Gauge rating and Chaikin Relative Strength. How to use Chaikin Money Flow to anticipate future price movements. This is that secret pattern that 99% of traders never see. I'm going to show you how to dramatically improve your timing with buy and sell signals, how to play good defense, avoid landmines that destroy portfolios, and particularly during earnings season, these landmines can really hurt. And then finally, we're going to show you how to use earnings alerts and options in Chaikin Analytics to supercharge your profits, and Tom's going to add quite a bit on the option side to that. I'll start by introducing myself. I've been on Wall Street for 50 years. I've lived through 10 bear markets. Even though we had a pretty big sell-off today, I don't think that's the start of something, although we did close, as you'll see in a moment, right at the top of the breakout zone at 2137. For 45 years, I've been using technical analysis to basically protect myself against bear markets, because when I started out, I was with a very fundamentally oriented research firm, Shearson Hamel. It became the basis of Sandy Weil's empire and so forth. And there were great fundamental analysts there. And then when the first bear market I had ever experienced surfaced in 1969-70, what had been a 2.5-year joyride where every day felt like an uptick, was suddenly very painful. And I realized that although fundamentals drive the market, if all you rely on is fundamentals in a bear market, you're toast. And I was managing client accounts, Series 7 registered, and both my own account and my clients were decimated. So I vowed that that would never happen again. And what I did was create some technical indicators like Chaikin Money Flow and Chaikin Oscillator, as well as some relative strength indicators. But now, because I've been mentored by some of the smartest and most successful institutional investors who were both colleagues and clients, I've created a fundamental indicator called the Chaikin Power Gauge Rating. It's the culmination of my life's work. I came out of retirement 7 years ago to create Chaikin Analytics and allow individual investors, and interestingly now professionals, to have the benefit of my 50 years of knowledge on Wall Street. Now, Chaikin Analytics is used by the pros and quoted in the media, so we've been fortunate, as has been Tom, to be on CNBC, to be quoted in Barron's and Forbes, but we also have some major hedge funds like Soros and Paulson, Fidelity Investments using it, and of course, Tom, Gentile, Money Market Calendar, Alerts, and Power Profit Trades also using it, as well as some well-known names like Malden Economics and Simpler Trading. So this is all to say that in the 7 years that we've been in the marketplace, 5.5 years since we introduced the Power Gauge Rating, it's working. And we're going to show you how it works and how you can use it to make money during earnings season. But I'd like to start out by asking you to look back over the last 3 months. Did you get spooked by Brexit and the tension about whether the Fed would raise interest rates? And more particularly, does earnings season have you spooked? If you do or you have, please type a big S into the Q&A box. And I see that like a lot of our recent webinar audiences, you're spooked by the volatility that surrounds things like earnings season, Brexit, and the Fed, and the headlines that go along with them. And I can tell you from 50 years experience that you got to be very focused to make money on Wall Street. And headlines, scare headlines, particularly on CNBC or in the financial press, can really throw you off balance. So I'd like to focus on the market to begin this webinar. I know Tom has his own thoughts on the market, and I hope he'll share them with us. But Chaikin Analytics gives you 3 proprietary indicators to tell you where the market is likely to be going. And that's so important in earnings season because you've got to have a frame of reference. You can't just trade earnings season without some awareness of what the market is likely to be doing. So we have 3 indicators. Chaikin Money Flow, which most of you know, on every online brokerage platform. It's on stockcharts.com, it's on Reuters and Bloomberg Terminal. We're applying this in a very specific way. It's been in the marketplace for over 35 years. We're looking at it relative to the SPY, the S&P 500 ETF, the most actively traded instrument in the US markets. Then we're looking at something called our power bar. This is a way to look under the surface at any index, ETF, industry group by measuring how many stocks have bullish versus bearish power gauge ratings. Remember, the power gauge rating is our fundamental indicator that I created in 2010 that does all the heavy fundamental lifting for you. I'm going to show you that in a moment. And then finally, something very special. I just started using this in webinars back in January. There's an ETF known as the Guggenheim Equal Weighted S&P. Now, many of you know that the S&P 500 and the SPDR ETF are capitalization weighted. Now, the reason that's important is because the largest stocks in the index, what was affectionately known as the FANG stocks, Facebook, Amazon, Netflix, and Google, had an outsized effect on the market in 2015. The average stock in the S&P 500 at some point had a 20% drop, as did the small cap stocks. But because those FANG stocks have such large market capitalizations, they dominated the index, and the S&P 500 in 2015 was actually up slightly less than 1%. But as you'll see in a moment, when you compare the performance of the equal-weighted Guggenheim ETF versus the SPY, you basically eliminate the need to go off and look at things like the McClellan oscillator, the advanced decline lines, new highs, new lows. This one indicator does it for you. So let's start out on this one-year chart of the SPDR by looking at Chaikin relative strength. Now, you'll see in a moment that we think information overload is a huge problem. You could go to Investors Business Daily and get relative strength for individual stocks as a number from 1 to 99. I think that contributes to information overload. We've converted a 6-month relative strength measurement to a red-green heat map. It's so easy to interpret. Can you see at the bottom of this chart how the relative strength of the equal-weighted S&P was bearish heading into late February, and then it started outperforming. So what did this mean? It meant that the average stock in the S&P 500 index, which is a large cap index, was starting to do better than the supernova FANG stocks. The reason this is important is because it tells you that there's confidence in the market and that you've got participation. When I started out in the business, they used to say if the generals are leading and the foot soldiers aren't following, the market's likely to reverse if it's going up. And the reason they said that is you had General Motors, General Electric, General Instruments, General Telephone. The concept is true today, 50 years later. In order to get a market that can sustain an uptrend, you need participation beyond just the biggest stocks. Now, from the spring of 2015 through March of 2016, the very opposite was true. The average stock in the S&P was underperforming the large cap names. That's why the S&P could not get through 2100 or 210 on the SPDR. Every time it banged its head up against it, bingo, sellers came in. So let's look at this W bottom that formed in January, February, and specifically related to Chaikin Money Flow. Now, declines of more than 10% in the market end in the form and shape of the letter W. Declines of less than 10% very typically end in the form of the letter V, like the decline we had in June, accelerated by that big Brexit panic. But going back to this W bottom here in the beginning of 2016, notice how Chaikin Money Flow stayed positive even as you broke below this lower volatility band, and then when you rallied up to the middle of the W, Chaikin Money Flow got even stronger, and when you came back down and exactly equaled the previous low in the SPDR, the S&P 1809, Chaikin Money Flow was very, very strong. What did that tell me? It told me that the institutions were taking advantage of the selling and buying, establishing equity exposure. Now, when you broke up through the middle of the W here in late February, roughly 1920 on the S&P, Chaikin Money Flow just kept climbing. You were having short covering, you had institutions who were underinvested, hedge funds who wanted to participate in the market. They go in, they buy the SPDRs, they buy some futures as well to get equity exposure quickly. And that strong money flow has continued as you broke out above the 2137 resistance level, which had stopped the market cold at 2100, 2137 level. And then you got Brexit. A lot of people were saying, oh my God, we're going to go back down and make a new low, maybe even get to 1600. There were people on CNBC telling you you're going to 1600, and smart people too, like Dennis Gartman and Gundlach, who runs 50 or 60 billion dollars. Well, they were wrong. They panicked, and then we came back up and we broke through here in June, made new highs close to 2,200, and now for the past 3 months we've been in a sideways trading range. Today's action saw the market close almost exactly at that breakout level. So next few days are sort of critical. The third thing we look at is the power bar. Now the power bar shows 101 stocks in the S&P with bullish Chaikin power gauge ratings, and you're going to understand in a minute what that really means, versus 110 with bearish ratings. So the fundamental skew is sort of even, and given the fact that we've been going sideways for 3 months, that's not too bad. But the key is money flow has been strong. The average stock in the S&P is still outperforming the large cap names. And when we look at the Russell 2000, the small cap ETF with the symbol IWM, we see a completely different picture. Again, small cap stocks were underperforming large cap stocks for almost a year. That ended in May when small cap stocks started outperforming. Money flow was great. And the power bar, if you look up here in the upper right, shows 631 stocks with bullish potential in the Russell 2000 and only 241 with bearish potential, better than a 2-to-1 reading. So whereas the S&P Spider ETF shows more bearish than bullish stocks, in the small cap index, which recently made a new high while the S&P was struggling, you've got bullish potential in a host of stocks. Bottom line, I'm bullish on the market. Our weekly market letter, we've been saying this for months. Earnings season should on balance be bullish. We're ending this earnings recession that's been going on for 6 quarters because energy prices have turned around. We're going into a seasonally strong period. After the election, you normally see the market go up. Fourth quarter is normally strong. So when I add it all up, I think the market's going to be higher by year end. And what we're going to show you on the balance of today's webinar is how to find the stocks that are likely to give you the biggest bang for the buck during earnings season and beyond. Now, Warren Buffett famously said investors should be fearful when others are greedy, and greedy only when others are fearful. So here's an example of that, which plays into this notion of a bull market. F5 Networks was in a downtrend, unloved by Wall Street, underperforming the market, neutral power gauge rating. Right after this earnings report in April, which was a negative earnings surprise but was accompanied by very strong guidance, and we'll explain the difference in a minute, F5 took off on the upside and started outperforming the market. That's a powerful pattern that we're going to put a name on in a moment. And the stock was doing really well, and then it spiked up from about 107 to 125. Why did it spike up? There were takeover rumors. There's a lot of merger and acquisition activity going on in the tech sector. And then along came Brexit. Big, sharp 2-day sell-off from 122 all the way back down to 107, and it triggered one of our 6 pairs of buy and sell signals. In this case, it's an oversold buy, really simple. It requires that the power gauge be bullish so that the fundamentals give you the wind at your back, that the stock make a new 8-day low and get oversold. I owe this concept to Larry Williams, who's been a sort of mentor to me based on the research that he's done over the last 45 years. But if you don't believe in a methodology and have a sense of where the market's likely to be going, are you going to be able to pull the trigger on that trade? And interestingly, it came 2 weeks ahead of an earnings report. And that earnings report was a positive earnings surprise back here in July. The stocks continued on to make a new high above 125. And then it pulled back and gave us another oversold buy signal. What you're going to see in this webinar is that the first signal after an earnings report, particularly if it's a positive or negative earnings surprise, is usually a highly reliable entry point. You can use it for swing trading. These overbought, oversold signals tend to last 5 to 10 trading days. We have a relative strength signal that has a longer shelf life of something like 4 to 8 weeks. and they tend to work 2 out of 3 times. So 2 opportunities to benefit by being greedy when others are fearful. The Brexit sell-off down to the lower volatility band and a stock with a bullish power gauge rating. And then after that positive earnings surprise, which is so important, and I'll tell you about that in a moment, you got another oversold buy signal. The stock went from 115 back up to 125. Now, as I alluded to earlier, our biggest problem in our daily lives and in our trading lives is information overload. Facebook, Twitter, Snapchat, email, LinkedIn, all the websites and the noise on CNBC. So the key is, going back to that focus slide when we focus on the market, right in the center of the slide, how do you focus in the age of distraction? Because it's the key to leading a sane life, having a little bit of time to enjoy the fruits of your labor trading, and also it's the key to making profits, because if you're distracted, if you're not focused, you're not going to make money. So really critical. Our solution to the information overload problem is Chaikin Analytics for both iPad and desktop. And the charts that you're going to see and the techniques are embedded in Chaikin Analytics, which helps you find profitable earnings trades. And the way it does that is by giving you a directional edge. We combine fundamentals, which are the Chaikin power gauge rating, with technicals into a quantitative model that summarizes the potential for a stock to give you superior upside performance or to bomb and hurt you on the downside. And then finally, we have Chaikin buy and sell signals for better exits and entries. Now, we're in a volatile market. I think everybody would agree. Alcoa reports negative earnings surprise. Everybody who was primed for a positive earnings quarter was a little bit shocked, down 10%, had a big impact on the market, down 1.25% at the close. So volatile markets demand a disciplined methodology. And this pyramid represents the Chaikin methodology. At the top of the pyramid, the Chaikin power gauge rating, your fundamental guide. We also like sector and group ranks, because if you can put the wind at your back with strong industry groups and sectors if you're trading for the long side, or weak sectors if you're trading from the short side, you get added confirmation. At the bottom of the pyramid, 2 only technical indicators. You do not have to look at 10 or 20 indicators. Chaikin Money Flow, which is available everywhere, and Chaikin Relative Strength, which you've seen. You could sort of simulate that with Investors Business Daily and their 1 to 99 rankings. Then right in the middle, that sweet spot, Chaikin buy and sell signals. Now the power gauge rating looks deceptively simple, but please don't confuse simple with simplistic. I like to say that the power gauge rating is like a Chevrolet with a Ferrari engine under the hood, deceptively powerful. And it can be your GPS during earnings season, as you'll see in a moment. Now, John Carter called this an awesome meter for stocks. He says there are a lot of hyped up tools out there, but when I find something interesting, I'll let you know about it. So you can imagine that a single tool that combines 20 plus technical and fundamental factors to anticipate a stock's potential got my attention. It's called the Chaikin Power Gauge Rating, and when I first looked at it, I thought this is an awesome meter for stocks. Now, here are the 20 factors, fully transparent. This is not a black box. We describe them on our website. We tell you how we compute them, and we also tell you why they are in the model. They're grouped into 4 components, so you can sort of make some logical sense out of them. And I will tell you that although the weights are proprietary, the financial metrics, the value metrics that a Warren Buffett would look at are 35% of the model. So they're sort of the bedrock. Earnings are 20% of the model, and I've boxed earnings surprise for a very specific reason, and I'm going to show you that in a moment. Technicals are only 15% of the model. We get the added juice from the technicals in our chart analysis, this bottom-up approach to picking stocks, and then expert opinions, which we think are our secret sauce, are not always found in a quantitative model. So we look at what the short sellers are doing. They're really smart. We look at whether insiders are buying their own stock. That's a tip-off and then we look at the trend of analysts' earnings estimates. Now, when I was at Drexel Burnham in the 80s, it's a firm that had an ignominious end, but was for a time on the top of the world, I got to work with their quantitative database developed by a gentleman named George Douglas. And George took me under his wing and taught me about earnings surprise because he did the original research on this. Now, earnings surprises happen during earnings season when companies report better or worse than expected earnings. Now, along with the earnings report is something known as guidance. Companies, based on all of these regulations that have been proffered since Enron and the financial collapse, have to give Wall Street some sort of guidance, and it has to be sort of transparent. They can't tell the big institutional analysts what they're not telling the individual investors. So, except for a very few companies like Google, who just typically doesn't give earnings guidance, companies will give you guidance. So earnings surprises tend to drive short-term stock price movements because they encourage analysts to raise or lower their estimates. But sometimes you'll get a positive earnings surprise and terrible guidance, and we're going to see that with Netflix when we get into the meat of the stocks we like to trade during earnings season. So here's an example of why our earnings surprise factor, one of the 20 factors in the model, is so important. Back in August, Urban Outfitters was due to report earnings, and one of the writers on Street.com said, take profits in Urban Outfitters now ahead of earnings. Stock was close to 31. Our earnings surprise factor, as you can see, was bullish. And you can actually screen for that in our screener. And look what happened. Urban Outfitters reported better than expected earnings, and the headline 5 hours later, excuse me, was Urban Outfitters is surging after trouncing expectations for earnings and sales. The shares jumped 11% in pre-market trading after the company reported. During the day, it was actually up 17%, making a new 52-week high. That's why the earnings surprise factor is so powerful. It's why it's one of the 20 factors in the model. And we're going to show you how to take advantage of that knowledge. Because one other thing that George Douglas taught me is earnings surprises come in bunches. There's never just one of them. So if a company has reported a couple of earnings surprises to the upside, they're likely to do it again. And you can use that to find winning earnings trades. Now, a little bit of the performance of the model, very brief, combining backtested and real-time performance, 5.5 years since January of 2011. Average very bullish stock in the Russell 3000 up 20% a year over 16 years. The average very bearish stock down 1% even after a 7-year bull market. Now in 2015, it really got interesting because the average very bearish stock in the Chaikin Power Gauge methodology was down 17%. And many stocks in the Russell 3000 were down 20, 30, and 40% with bearish ratings. The average very bullish stock matched the index down about 1%. But these were your fracking stocks, Range Resources, Pioneer, railroads, cloud computing stocks, small cap stocks in general. It's the ability to capture that difference between a very bullish performance and a very bearish potential, which leads to disaster very often. That is at the heart of the Chaikin methodology and its ability to help you find winning trades during earnings season. So let's start out by looking at a classic Chaikin bull pattern. Power gauge rating is bullish, which tells you that the fundamental potential is solid for that company. It's outperforming the market. I'm a firm believer that stocks that outperform the market give you the best bang for the buck. And Chaikin Money Flow should be green, not red, telling you that institutions are buying the stock, not selling it. Now, here's a stock that we've been using on these webinars for the past 4 months as a classic Chaikin bull, Tyson Foods, poultry producer. Series of positive earnings surprises. Even this one that's labeled negative was accompanied by positive guidance, so the stock went up. But look what happens. Big spikes in the stock, after their earnings reports. Now, everything was going swimmingly for Tyson's until last Friday, when a very little known research firm put out a bearish market letter on Tyson's, reducing their target from 100 to 40. Pretty dramatic. And Wall Street doesn't wait around to validate someone's passport when it looks like they're a terrorist, so they just sold the stock. Now, using our new news feature, you could have immediately clicked, blown up the news headlines, and seen that this brokerage firm, which nobody's ever heard of, keyed in on some lawsuit from 6 weeks ago. All of this triggered a 10% drop in the stock. But then Tyson said, we take exception to this report. This just isn't likely to happen the way they're saying it's going to happen. And brokerage firms like Jefferies and Company weighed in and reiterated their buy rating. So what happened? Tyson's Foods started a rebound on Monday, and then again this morning until the market really took it on the chin. So using Chaikin Analytics, you're getting everything in one place. And that really is why we say this is our solution to information overload. And Tyson's is probably going to regain most or all of that 10% drop. And you've got an earnings report due out on November 28th. Here it is right up here. Next earnings report, Monday, November 28th. You've had 3 positive earnings surprises in a row. Chances are you'll get a 4th. And we have an earnings alert indicator. That's that exclamation point, which can be either red or green. In this case, it's green, which means that there's some combination of analysts raising their estimates and these earnings surprises going back a number of quarters. So this is a stock you want to watch heading into that November earnings report. Now, a classic Chaikin bear is just the opposite. Bearish power gauge rating. Performance is weak relative to the market. Chaikin Money Flow is red, not green, telling you that the institutions are selling that stock every chance they can get. And here's our classic Chaikin bear. CF Industries, second largest fertilizer company in North America. Notice that there was a negative earnings surprise back in November of 15, but the power gauge rating was already bearish. And look what happened. Remember I told you earnings surprises come in bunches. 3 more with the next earnings report due out on November 2nd, and a series of these overbought sell signals, new 8-day highs with a bearish power gauge rating. These are the stocks you want to avoid. They're ideal put candidates. If you see a signal ahead of the earnings report or that one right after the earnings report, this is usually a really good options trading opportunity. Now, in Chaikin Analytics, we have a variety of ways to find these stocks so that you can sift through 5,000 stocks very efficiently. One of them is our power gauge hot lists. We show all bullish or very bullish stocks, stocks that have turned bullish or bearish this week, and so forth. So easy to find bullish or bearish trading candidates within Chaikin Analytics. Now, I said earlier that this combination of relative strength and the power gauge rating is really important, and we've given it a name. We call it the dynamic duo. And the dynamic duo finds big winners and losers. I've learned in 50 years on Wall Street that superior returns come from stocks that outperform the market because they tend to continue to outperform. With one caveat, and we'll see an example of that when we look at the McDonald's chart. Relative strength stands alone as a bullish or bearish indicator. How many of you are momentum traders in the webinar audience today as opposed to swing traders? If you are, type a big M in the Q&A box, please. And we know that there are a lot of momentum traders out there. They want to hitch their wagon to a star like they did in the internet boom in 1998-9 to 2000. Housing boom preceded the collapse in 08. But just be mindful that if the fundamentals don't support that momentum stock, ultimately something's going to come along and you're going to be on a high wire without a safety net, and the fall is very painful, as we'll see in some stocks in a moment. Now, here's an example of what we call the dynamic duo, which is strong. It's an aerospace stock called Huntington Ingalls, HII. Everything was going swimmingly. Bullish reactions to earnings reports, 3 out of 4 were positive. Buy signals right after an earnings report tend to work out very nicely, 3 out of 4 of them. 2 out of 3 are going to work. And the money flow stayed very strong. But now we're going to get into the weeds on a pattern that 99% of traders never see. And that pattern is really powerful. If a stock makes a new high, particularly near that upper volatility band, but Chaikin money flow stays red or negative, what is that telling us? It's telling us that the institutions or smart money is selling that stock into strength. Who's buying it? It's typically the public. And so you had the opportunity to sell HII if you had bought on any of these swing trading signals right at its all-time high. That doesn't happen to us very often in Wall Street, but using this approach, it'll happen more often than you think. And now if you look up here, the next earnings report is due November 3rd. Our earnings alert indicator is red, signaling the fact that Wall Street analysts are lowering their estimates on HII. And you want to watch out and look for a put buying opportunity heading into that November 3rd earnings report. Now, the power gauge actually turned bearish after that negative divergence here at the high. So this is a stock where we're looking for opportunities to sell on strength. Now, a classic example of a dynamic duo being weak is SunEdison. SunEdison was the darling of the solar energy group. Merrill Lynch had a buy rating on this stock at around 28. It too had negative money flow as it was making new highs above 30. But the power gauge rating turned bearish in July, and immediately the stock started underperforming the market. There's your dynamic duo on the downside. And most of you know what happened to SunEdison. SunEdison took a steep drop with negative earnings surprises all the way down, gave you some opportunities to buy puts on these small rallies, ultimately filed for bankruptcy. Along the way in January, Merrill Lynch put out a sell recommendation at $3 a share, having recommended it in the 26, 28 area. You can avoid these stocks and follow these signals ahead of earnings using put options to limit your risk. So back here in November with a money flow sell signal, ahead of that bearish earnings report, really nice short sale or put buying opportunity. Now we got this testimonial from someone at a conference in California back in May where we were exhibiting. He said, after coming over to the booth and seeing that chart on SunEdison, if I had only had Chaikin, I could have saved my clients a lot of pain and suffering because I'm with Merrill Lynch. I bought SunEdison on the way down at 15 because they were still recommending the stock. And if I'd been using Chaikin, I wouldn't have done that and it would have saved a lot of pain and money for myself and my clients. Now, the second pattern that we've really zeroed in on to help make these concept so simple to take away from the webinar is the idea of knowing how to spot personality changes. I think it's the key to making and keeping profits. Biggest mistake we make as traders or investors is to fall in love with our stocks. Tesla's a classic example. It's got acolytes who are following Elon Musk to the precipice, in my opinion. You've got to know when a stock has started to underperform the market after outperforming it. That's what a personality change is, or vice versa. You don't want to be on the wrong side of that door when Jack Nicholson's coming through with the axe. It's painful. So here are two examples. This is a stock that recently had a bullish personality change back here in July. It's Aris International. And I actually made it my bullish stock of the week in Chaikin Market Insights, which comes bundled with Chaikin Analytics just this Sunday. The reason I did that is on Friday, the stock was up 7%, spiked up, triggered 2 buy signals in Chaikin Analytics because they announced a big warrant deal with Charter Communications, second largest cable company in America, which requires Charter to buy a minimum amount of equipment. This is streaming video technology. Comcast had already signed on to a similar agreement, and Wall Street analysts who were turning bullish on the stock really jumped on that. The stock was up 7%, and what I said in my market letter was, don't chase the strength here. Wait for a pullback under 29, 28.5, 29 area. Look what it did today. Down 3%, 28.71. The next earnings report is 2 weeks from tomorrow. We have a bullish earnings alert. This is a stock that you want to buy on weakness, because look what happened the last 2 times they reported. First of all, 4 positive earnings surprises in a row. Spike up big time each of the last 3. And notice these spikes normally lead to a consolidation. Occasionally you'll keep going, but most of the time it's a great spot to take profits off the table. And let's all be looking for an opportunity to buy ARIS or call options on ARIS ahead of that Wednesday earnings report on October 26th. Now, by the way, we have intraday charts in Chaikin Analytics. I know there are some subscribers on the webinar today who subscribed from past webinars. We've added intraday charts with alerts. So there was a gap down at the opening and the stock just kept going, giving you that buying opportunity. Now, here's an example of a bearish personality change. It's Starbucks. When did that bearish personality change take place? Back in February. Now, when you have a bearish power gauge rating and you're underperforming the market, the likelihood is that your earnings reports are going to disappoint. And in this case, not only has Starbucks failed to go anywhere over the last 9 months, but it made a new 52-week low today after gapping down on the opening. If you can eliminate these stocks from your portfolio, use them during earnings season as bearish plays, you're going to make a lot of money. Now, one final pattern, and then we're going to get into some really interesting earnings plays. We call it stealth buying and selling, and it happens because institutions take large positions and they can't exit or enter them in one day, so they leave footprints. And here's an example of that. This is those trades that 99% of traders never see. We call it stealth accumulation. Chaikin Money Flow is an oscillator. For those of you who are technically oriented, it fluctuates around a zero line, looks back over 21 days to monitor institutional and buying and selling. When you get a 3-week sell-off in a stock and Chaikin Money Flow stays green or positive, you want to be buying that stock. It's called stealth accumulation. In this case, it came on Quad Graphics, which had just had a bullish personality change with that dynamic duo strong. And the stock went from $12 all the way to $28.5. That's what can happen when everything lines up. Now, this happens to be a small cap stock, so that fills the sort of IWM mandate of small caps leading the market, and the stock has in fact been leading the market. And you see that about 2 out of 3 of these signals work. Now, the one in August came in the middle of a bit of a market correction, didn't work, but then we had an oversold buy signal just again in September, and you got a nice trade out of that. Here's an example of stealth distribution, McDonald's. And it's also an example of the fact that if the fundamentals don't support a big momentum move, and McDonald's had a big move from the high 80s all the way to 130, outperforming the market with positive Chaikin Money Flow, but the fundamentals just never lined up, so the power gauge stayed neutral. And then you made a new high right after an earnings report here in early May, and look at the Chaikin Money Flow. Just as with HII, Chaikin Money Flow was negative at a new high. Great spot to run for the exits. Take your profits, take money off the table at 130. New all-time high for McDonald's. Shortly thereafter, the power gauge turned bearish. It was at around 124, 125. So you could have gotten out of McDonald's between 125 and 130 if you believe in this methodology. And then look what happened when they reported earnings in July. The stock dropped from 127 all the way down to 115, and it's made no progress ever since. And these signals after a earnings report that's reaction, the marketplace is negative, are great opportunities, and now you've got stealth distribution going on. Notice that every rally in McDonald's sees the Chaikin Money Flow stay negative. Institutions are not buying the stock. Shorts aren't covering the stock. They think the stock is going lower, and it's trading today at 113.74. So it's down about 10% in a period where the market has made new highs. Now, back in May and June, if you like the fast food industry, you might have been buying Jack in the Box, which reversed a series of negative earnings surprises in early May. Money flow was positive, but people were negative coming into that earnings report, spiked up and just kept going. So you have two ways to get into a stock, and I'm sure you know Jack in the Box competes with McDonald's in the hamburger business. They compete with Chipotle in Mexican food business. And the stock's been a barn burner. So you could have bought it at 75 after it went sideways for 4 or 5 days, because that's what I like to do with momentum breakouts. Don't want to buy that breakout. Want to buy it when things have calmed down. If you're an options trader, implied volatility starts to narrow and you get a better bang for your buck. Or you could have bought that first buy signal after the earnings report at a price of about 82. And where did a Jack in the Box go? It went over 100. Power gauges turned neutral, but money flow and relative strength is strong. So you have two choices here. And Wall Street is all about choices. You could have sold McDonald's between 125 and 130 on its way to 113, or you could have bought Jack in the Box in the same sector and industry group at 75 or 80 on the way to 100. You tell me where you'd rather be positioned. And then when we look up here, we see that the next earnings report is due out on November 15th. We have a bullish earnings alert indicator. That's that green exclamation point. That's telling you that analysts are raising estimates, and it's recognizing these last 2 quarters of positive earnings surprises. So the chances are that you'll do it again. You did it here in May. That surprised people. In July, you should have been expecting this because money flow was strong, and sure enough, big spike up, likely to happen again in November. Now, we have 6 pairs of buy and sell signals. They're fully disclosed on our website. Whether you're a subscriber or a visitor, you can go to the website and see the basis for this. 4 of them are filtered by the Chaikin Power Gauge rating. 2 of them don't care. They only want the stock to be outperforming the market. But it's really important to acknowledge that when you're trading, you've got a discipline, whether it's Tom's money calendar trades or the alerts that he's giving you. You've got to have a discipline, a system that you can count on that gives you conviction to pull the trigger, because those Brexit buys, like we're seeing here on Varian Medical, are pretty tough to pull the trigger on unless you think that you've got a disciplined methodology based on proven analytics, because that is how you're going to make money following the signals, and it's a lot better than trading on your emotions. Now, to help you find these signals, we've got a dashboard that shows you the alerts for any list, ETF, index, you name it. Just click on that index or your own list called My Stocks, which is what I have up here, from a webinar I did on September 20th. On that day, I singled out eBay, which our computer had picked for one of the portfolios that is being managed at First Trust Portfolios based on the Chaikin methodology, which gave an oversold buy signal at 31.57, and Nike, which had a momentum breakdown at 54.95. So let's see how those 2 trades worked out. Well, eBay went from 31.47 all the way to 33. It's now correcting with the market. And Nike did just the opposite. There's your momentum breakdown at 54.95. And today the stock made a new 52-week low, trading under 52. This is what the discipline of following a methodology and following the signals can do for you, and we make it easy for you to find these. Now, the next to the last section of the webinar talks about playing good defense, because good defense can help protect your portfolio and your 401k plan, or protect you from unforeseen disasters during earnings season if you're a trader. So how does it do that? How do you play good defense? Well, Herb Greenberg, who used to write for Street.com and CNBC.com, said it's the stocks you don't own that matter. Very powerful concept, not normally acknowledged on Wall Street. You can reduce risk by avoiding mistakes. You should also be avoiding weak industry groups if you're trading from the long side or populating your 401k plan. You've got to know what stocks not to buy. Bottom fishing is probably the most expensive entertainment in the world. And you can improve performance by eliminating potential losers from your portfolio, or you can use put options to either profit from down moves in these stocks or protect your portfolio. So 2 examples of stocks you didn't want to own in 2016. Here's Campbell Soup. Had a bullish rating at the beginning of the move back there at 50 on the way to 67, which is a big move for a pretty mundane packaged goods food company. But then the power gauge turned bearish, started underperforming the market with the stock above 60, and you had a money flow sell signal 3 days before earnings were due out. Notice that earnings were no great shakes, just meeting estimates. Turned out that was a great put setup. So what is a money flow sell? Power gauge is bearish. That's at the bottom of the 1-year chart as a ribbon, red, green, yellow. Stock trades above a short-term moving average, think 8-period exponential, and then drops back below it with negative money flow. Again, this signal has a duration ideally of 5 to 10 trading days. And wouldn't you have liked to have bought put options on Campbell Soup just 3 days ahead of earnings and watch the stock drop from 60 all the way down to 54? Option premiums are not very high on a stock like Campbell Soup. That 10% move can translate to triple digits in a well-chosen option. And sadly, Chipotle, where the power gauge rating turned bearish even before the E. coli problems surfaced and before this negative earnings surprise, turned bearish in November of 15 with the price at about $6.95. And then they reported a negative earnings surprise. And it was basically downhill all the way. And right here is when they reported the first E. coli case. So the stock was still 600. But by that point, money flow was negative. The stock was underperforming the market. Chaikin power gauge was bearish. It's the ideal setup. And if you're playing good defense, you're not bottom fishing. You're looking for put buying opportunities. You're looking for opportunities to turn the world on its head and take advantage of what you know that the rest of Wall Street doesn't know. Now, Chipotle has been very volatile since it made its low under 400 back in June. A big hedge fund manager announced that he had a 10% position in it. The stock spiked up to 440, pulled back under 400. After their last earnings report, which was a bomb, the stock spiked up almost 10%. That's how irrational Wall Street can be. Some brokerage firm put out a buy recommendation after a negative earnings surprise where the company basically said, we haven't cracked the code to how to bring our customers back into the stores. Now, the next earnings report is due out Tuesday, October 25th. We've got a bearish earnings alert. The stock rallied up to the upper volatility band. You could have put on a put position at that point. But look what it did today. In a weekday in the market, down 3% plus, trading down to 423. If you get a bearish earnings surprise, on October 25th or negative guidance yet again, you can be sure that this stock's going to trade below 400. Now, the power gauge has turned neutral, but I'm still looking at this as a potential put candidate. Now, we got a testimonial, and I've tried to be light on the testimonials because I know they can sometimes overwhelm the educational part, but we got to do a little of that because these are real people using these techniques to make money in the market. So GC said 10x return in 5 days. In the 5 business days that I've been using Chaikin Analytics, I've paid for the subscription over 10-fold. These initial results are nothing short of astounding. Please extend my thanks to the entire Chaikin team. And team is really the key here. My wife Sandy and I started this company 7 years ago. We're now 25 people here in Philadelphia, and we're dedicated to your success, to helping you get up to speed, learn these techniques, make them yours, become independent, and walk with you every step of the way, because trading is a journey. I learned that over 50 years ago. Now, the final piece of the webinar is how you can make outsized profits during earnings season. Now, most companies report on what's known as a calendar year basis, meaning their fiscal year ends in December. So they report fourth quarter earnings in January, then they report again in April, July, and October. That's what we commonly refer to as earnings season. Typically spans 6 weeks. Alcoa kicks it off, as they did today, and then 6 weeks later, Walmart reports, and earnings season is over, although you get a smattering of earnings reports. For instance, Nike reports not in January, but in February, because they have a different calendar year. Now, earnings season scares a lot of people. We know that because your response to our first question was that sometimes spooked by earnings season. The reason is there's a lot of volatility during earnings season. But for us, because we've got the power gauge rating and our earnings alerts and our earnings surprise indicator, volatility equals opportunity. There's also a lot of speculation in the media around earnings reports. You go on CNBC and see how convincing some of these analysts can be about whether or not a company is going to meet or disappoint, and they typically contradict one another, so nobody can be sure about who to listen to. But if you know with some degree of reliability whether a stock will meet, beat, or disappoint, you can find these outsized trades. So we looked at that montage with Urban Outfitters before they reported in July. So here is the positive earnings surprise that pushed the stock up 16%. And that was a good spot to take profits if you were already long, because you had pretty much a 5-week sideways to down movement. Remember I said that first signal after a positive or negative earnings surprise is normally a great spot to buy the stock. And in this case, Urban Outfitters pulled back to 34 from 37, and then it moved back up toward the new highs. Now, they report again on November 21st. I know Tom is going to weigh in on this at the end of the webinar. And we've got an earnings alert indicator that's positive, suggesting that you'll get another positive earnings surprise when they report in November. Now, here's another example where Wall Street could have put you on the wrong side of an earnings surprise. PVH, which is one of our favorite stocks for trading in earnings season, you'll see why in a minute, was due to report on March 22nd after the close. The headline in thestreet.com was PVH stock closed down ahead of tomorrow's earnings. They're actually due to report after the close. Jim Cramer said, exercise caution with PVH ahead of earnings. But our earnings alert indicator was bullish, and after PVH reported, look what happened. The stock jumped 6 points in the pre-market. So if you were following Wall Street and you own the stock, you probably would have sold it. Certainly weren't looking at it as a buying opportunity, but look what happened to PVH. First of all, Chaikin Money Flow was very strong, and at the bottom of the chart, the power gauge rating was bullish. Now, PVH makes Calvin Klein jeans. They make Van Heusen shirts, Maidenform bras. It's a big apparel company. Makes socks. the stuff all of us wear every day. And it's had a history of positive earnings surprises. And it typically spikes up after those earnings surprises, as you see here on the chart. So buying the stock ahead of the earnings is usually a good thing, unless you're listening to thestreet.com and some of those columnists who really don't have any more information than the rest of us. In fact, we have better information. So here on the top of the chart, we see that PVH is due to report in December. We've got a bullish earnings alert. The stock just made a new high yesterday, sold off a bit today. And those signals after earnings or before earnings are great opportunities to get into a trade and then use that earnings report to exit with a big profit. Power gauge rating is bullish, money flow is bullish, outperforming the market. That's our ideal setup. We just want to find the entry. Now, Priceline is another stock with a bullish power gauge rating and a history of positive earnings surprises. Our earnings surprise indicator is bullish. They're due to report on November 14th. There have been a number of buy signals both before and after recent earnings surprises. You want to take advantage of them. But we have another, let's call this a bonus, because we really didn't advertise that we were going to do this. There's a great way within Chaikin Analytics to find winning earnings trades. In this case, it's going to be on the downside. We rank the 9 select spider sector ETFs. There are now 10 of them, with real estate having its own ETF. And we rank them by the number of stocks with bullish versus bearish power gauge rating. So energy, healthcare, technology, materials, and finance are right at the top. But look here at the bottom, because we're looking for bearish trades during earnings season as well as bullish. Consumer discretionary, 12 stocks with bullish ratings, 18 with bearish. Consumer staples is even worse, and utilities is worse yet. Now, consumer discretionary is not a homogeneous sector. It's got lots of different industry groups in it. Some of them are bullish, some of them are bearish, but universally, the apparel stocks are bearish. We saw that with Nike. So if you see a sector like consumer discretionary that has more bearish than bullish power gauge ratings, go in there and find the bearish stocks. Now, Netflix is a stock where we've had a lot of success during earnings season. This is before the 7-for-1 split, the big rally to 700, and then the 7-for-1 split. Back in October of 2014, we had a overbought sell signal just a week ahead of earnings report, and the stock disappointed and dropped from 440 all the way down to 335. People who bought out of the money options made 50 times in one day. And by the way, Netflix has a history over the last 4 years of disappointing when they report October earnings. So what's coming up here? We'll see in a moment. We got this testimonial from JV. I decided to add Chaikin Analytics to my resources using the upcoming earnings ideas in Chaikin. Netflix had a very bearish rating. I bought 3 put contracts before earnings on 10/15 for $22.20 and sold them the day after earnings for $93.90, a quick $21,000 profit. Now, let's look at Netflix now. The power gauge at the bottom had been bearish. Ahead of the previous earnings report, you had a beautiful overbought sell signal where the stock dropped from 110 all the way down to 87, giving you fabulous profits. And now again, we're due to report earnings this coming Monday. Now, Netflix is hurting. Not going to get into the fundamentals. Power gauge happens to be neutral, but if we drop back below 99, it's going to turn bearish again. They're losing market share here in the States. They're losing subscribers. They're putting out expensive content like Narcos and House of Cards. They're trying to make it up in Europe, and it's not working. So this is, as you'll see, one of my favorite stocks to trade during earnings season. Given the pattern of October negative surprises, looking for an opportunity as close as possible to that Monday report to buy an out-of-the-money put option or put on a spread because Netflix is very volatile in earnings season. Now, here's another apparel stock in consumer discretionary, Under Armour, where the power gauge rating has been bearish off and on for a year. It's now bearish with negative money flow and underperforming the market. We had an overbought sell signal. They report on Tuesday, just 2 weeks from today. Our earnings alert indicator is bearish, which suggests a negative earnings surprise. And if they do report a negative earnings surprise, and it's sort of an industry trend, the industry group is weak, the technicals are weak, Coach is weak, Nike's weak, Lululemon is weak. If they do report a negative earnings surprise in October, this stock will spike down to a new low in the 32, 34 area. So with the stock up here at 38, looking for put buying opportunities. If you want to play it very close, look for something closer to that October 25th earnings report. If you're putting on a spread, not as important. Now we have a screener that helps you find earnings plays. In this case, I took the Russell 3000, required that the power gauge be bullish and the relative strength be strong, and that we're looking for large or mid-cap stocks that are reporting earnings within the next week. So we narrowed that universe of 3,000 stocks down to just 17 names that we can really zero in on. Stocks like Citigroup, Intel, JP Morgan, Bank America, all due to report within the next week. Trying to find earnings opportunities. So simple to go through just 17 charts and look for the signals. Now, we got this testimonial from Mark W., a fast and efficient process. He was using our screener to find earnings trades. I had a 90% average return in my first 6 earnings trades using Options Play, which is our built-in options idea module that we license from a company called Options Play, and the earnings features. All very simple trades. Chaikin Analytics makes the process fast and efficient. So instead of getting bogged down in due diligence, I was trading. And his first 6 trades are there. He was kind enough to share his blotter with us. 90% average return. So now you know how to find winning earnings trades during earnings season. And as promised, here are our 5 favorite stocks to trade during this earnings season. Netflix, PVH, Under Armour, Urban Outfitters, and Priceline. You've seen the charts, and now, Tom, I know you've got some options insight for the folks on a couple of these stocks.
Yeah, so Mark, you and I talked about this right before the webinar began, and I already had my eye on a couple of these. But what I did was I went in and did some options homework on these. So I'm just going to mention them a little bit, but I'm going to tell you the ones I think that have some really good, interesting option plays on them. And you know, we can't get specific because some of these go out into, like, Priceline is in November, so I don't know what the options are going to be trading at in 2 to 3 weeks, but that's when I want to really start looking at this. Earnings can be, earnings are a short-term event, and you know that, and I know that, but a lot of people that are on the webinar really don't know that. And to me, it's a dance where timing makes a lot of sense too, timing the entry and timing the exit. So let's just go through each one real quick. I'll tell you what I found. Netflix. Now, Netflix has an average of about 30% increase in the options premiums as we get into, say, the last 2 weeks before the earnings happen. It's already up. It's already on the way. I mean, we've seen about a 10 to 20% increase already in Netflix because it actually started a little bit earlier than it typically does. The last 4 earnings cycles, I'm seeing about a 3-to-1 in terms of options premium jumping up before earnings. The option traders right now, if we were to gauge it today, expecting about 11% change based on the last 4 quarters of what Netflix could do after they report earnings. So if you expect it to drop, then the average change, and this is based on, I look at the last 4 quarters and I look at what's happened over the last 4 quarters, but you can also do it very simply by adding up at the money call and time premium for the week that the earnings actually come out. And you'll find that there's so much time pushed into this right before earnings that these guys are expecting about a 10, 11% jump one way or the other. If we expect it to go down, then you should time your bearish play, if you're going to look at options, you should look at perhaps spreads that do not exceed more than 10% to the downside. So maybe you buy a 5% out of the money option, put option, you sell it one that's 10% out of the money, you create a bear put spread that way. So that you've helped to reduce the time risk because it's there. PVH, I think, is really cool because this one, I looked at this one kind of a best in class. And the reason I say that is because the IV going into PVH, the analysts have screwed this one up so many times. You've got it right and they're getting it wrong. And what's happening is, you're getting these jumps in price much greater than what the expectations were. And IV is now, it climbs to around 50%. It goes up 50% the week to 2 weeks before earnings are reported. So there's a lot of interest pumping in to expect some kind of jump. Now, what's ended up happening is that the expectation I see coming into this earnings is we're looking for about a 4% stock change, right? I don't know what you see, Mark, but we're seeing about a 4% change based on options traders one way or the other. So if you like PVH to the upside, this is one where I think buying in the money calls might make a good sense if you plan on holding it through earnings. You want to get in deep enough where you get yourself away from the time premium because that's what kills people in earnings. You could be right on the earnings, you could be right on the stock, but if you buy that option and it's too highly priced in time value, you could actually lose money being right, and it does happen. Under Armour, we're expecting right now, as of right now, about an 8% change when the earnings come out. The IV, or the implied volatility, climbs an average of about 22%, but that's been 2 and 2, the way I look at that. So the last 4 quarters, we've seen 2% on the climb and 2% not so much. Urban Outfitters, let me talk about that one for a moment because that one's really nice. First of all, it's climbing an average of about 30% in implied volatility, which means there's a lot of rush to get into this thing. I call it, in the options world, we're ticket scalpers, right? We're going to the event, and I'm going to scalp these option tickets. And the event is, think about the event, and it's at the Coliseum, and the event is called Urban Outfitters Earnings, and everybody's cramming in to see what they're going to be. But you need a ticket to get inside, and I'm selling those option tickets as fast as I can, and more demand's creating those option prices to go higher. Well, once the event comes out, here's the problem. Urban is best on the climb up into earnings. It's got the best price change of all 5 of these. I'm expecting a 16% change in the price of the stock. Now, there's no guarantee it's going to happen, but that's what the option traders and the option premiums are telling me. But they got a great price change before earnings. They got a great price change after earnings, but they have the biggest crush in implied volatility of the 5 we see here. And that's because once that event is known, then the crush and volatility is huge with Urban. So I would say this is one where you want to consider selling premium into earnings. If you think it's going higher, if you like what Mark has talked about, and you like this to the upside, sell puts. I don't even like saying that, but sell put spreads. Sell put spreads at least gives you some protection in the event that things don't happen the way they normally have, and the way the pattern suggests. And then finally, we got Priceline.com, which is sitting here on the screen right now. Now, PCLN has roughly about a 25% increase in option premium as we get to its event, all right, which is the earnings event. Now, this one's interesting because I like this one for a number of reasons. It goes up into earnings. In fact, the last 10 years, during this session, during the cycle, which is call it the 2 weeks, 2 to 3 weeks prior to earnings, it has gone up 10 out of 10 years on the 3rd quarter between mid-October and around the 1st to 2nd week of November. Last 10 years, it has done that. Earnings plays a big role in this, but you know what plays, I think, even a bigger role is what happens right before earnings. The problem is that if you buy a spread on Priceline, you really got to sit through it into earnings. You can't just, Mark, I don't know about you, but I'm not going to go out there and buy calls on Priceline. They're too expensive.
Premium erosion is going to kill you.
Yeah, so you got to spread it. If you spread it, then if you really want to make the big money, then more than likely you're going to have to sit through earnings because you need that volatility to come out, and you need your spread to, between now and earnings, go from maybe an out of the money spread to an in the money spread, so that once the earnings come out, then the crush happens and that spread widens out. You could even look at doing out of the money put spreads with it too, but your reward to risk ratio is going to be much less than 1 to 1. So I like this one because we have a pattern. The price pattern has been fantastic the last 10 years in a row, and even our money calendar alert students have benefited from this particular quarter into Priceline. And you're just showing one more reason why that happens. So,
well, Tom, thank you for all that. And it just validates what I've been saying since we started doing these webinars together, you to our audience and us to the Tom Gentile audience. There's so much synergy between this very methodical, probabilities-based approach that Tom takes and the Chaikin Power Gauge rating and our money flow and relative strength indicators. It's really a powerful combination. And without having to know all the ins and outs of implied volatility and premium analysis, Tom is giving you a synthesis of all of that with his recommendations. And here we are intersecting on stocks like Priceline and Urban Outfitters, PVH, and Netflix. When you get two totally independent forms of analysis converging, you should have a lot of confidence in that trade. Will they work all the time? Of course they won't. Nothing ever does. But you're approaching the options trading decision and the stock trading decision during earnings season with more information than the pros have. So we've been talking about Chaikin Analytics, which now includes a stock screener, as you see, options play, earnings alerts, and intraday charts. And Chaikin Analytics normally sells for $1,950 for a 1-year subscription. As a webinar special, we're taking $200 off the price of Chaikin Analytics, reducing the cost to only $1,750 a year. And that offer expires Friday, October 14th. You can go to chaikinanalytics.com/profits. Joe Bicella is going to put up that link, and we're going to show you in a minute how easy it is to click on that link and subscribe to Chaikin Analytics. But in addition to everything you've seen, our team adds real value to your subscriptions. We give small group and one-on-one tutorials to help you learn everything you need to know to get started with Chaikin Analytics, to get you set up, to know what the features are and how to use them. And this is really something that most people don't do in our business. My colleague John Schlitz writes a daily morning market commentary, so you don't have to be glued to CNBC to know what happened in the overseas markets or in the futures or the bond market prior to the opening. And then I write my weekly market insights, which is a newsletter that comes into your inbox on Sunday afternoon, prepares you for the week, gives you my thoughts on where the market's headed, looks at the sectors, industry groups, and also gives you a bullish or bearish stock of the week. Now, just a few weeks ago, I featured Electronic Arts as my bullish stock of the week. It was trading under 80. Power gauge rating was bullish, outperforming the market. Look at the Chaikin Money Flow, big accumulation going on. And I had just gotten an oversold buy signal down here at 79.45. And it had come right after a bullish earnings surprise. In fact, the stocks had a pattern of 4 earnings surprises in the last 4 quarters. So that stock traded from 79.45 and made a new high above 85, which was a lovely swing trade. Whether you use options or bought the stock, you want to take that profit because that's that 5 to 10 day window that these oversold buy signals project. Now, the next earnings report is Thursday, November 3rd. We've got a positive earnings alert indicator. Likelihood is another positive earnings surprise. You want to be prepared for that, particularly if the power gauge turns bullish. It's turned neutral now. Now, Tom gave us this wonderful testimonial. Gain the edge needed for trading success. As a rule-based trader in both stock and options, I rely on quantitative analysis to give me the edge I need in trading. Chaikin Analytics delivers something that very few software tools do, the ability to have superb charting capabilities, but also Marc's proprietary algorithms not found in standard charting software. I highly recommend Chaikin Analytics to anyone looking to gain the edge needed for trading success. So to make this even more attractive, we're offering you a fast action bonus. If you subscribe by midnight tonight, we'll take an additional $100 off, reducing the cost of Chaikin Analytics to only $1,650 a year. And as you saw from some of our testimonials, we have subscribers who've made multiples, 5 to 10 times the cost of the software in the first 2 weeks of using the system because of this intense education that we're committed to, where you learn the system very quickly. So with that, I'd like to turn it back to Tom for whatever closing comments he wants to make. And then Joe Bicella is going to click on that link. In fact, Joe, you can do that now if you'd like while Tom's talking to show you how easy it is to subscribe to Chaikin Analytics tonight and be on one of Joe's onboarding sessions tomorrow.
Thank you, Mark. And guys, I just want to just kind of reiterate what we've done here. So Mark's come in and he has done a couple of webinars for us this year for the Power Profit Trade readers. Again, thanks again, Mark, for doing this. This is very educational. And, that's the big thing that we try to do with these webinars is educate you. And if you're interested in the offer that we have here on the screen, that's great. But big thing is education, and we all have different views of whether we're long or short, based on maybe fundamental analysis or technical analysis. I do a lot on seasonal analysis. But to me, the big thing you need for long-term success is to become a rules-based trader. And this is a great start. I use rules-based trading in my approach every single day. And I've got a lot of option analytics at my disposal to look at option premiums, to look at implied volatilities, to look and see when the crush is likely to come, short-term, intermediate, long-term. But, I'll say it here. I believe Chaikin Analytics is one of the best stock analysis programs that I've come across. And I've been in this business now well over half my life. So, we're talking quite a few decades here. I don't want to give my age away, but I've seen a lot, and this is one of the cleanest cut, really easy to understand tools that's out there. And Mark, you've done a wonderful job with it. My brother-in-law, once he gets settled, he is very eager to use the Chaikin Analytics package, as we've talked about on other programs as well. But again, I just wanted to, give a thanks to all the listeners out there today. Glad to have you as part of the program. And Mark has done a fantastic job and really bringing you a product at a fantastic price, because he doesn't offer it for this price, outside of this room. This is something special that he's doing for our group. So if you're looking for something that can do more than just give you a chart on the screen, this is the package you want to take a look at.
Well, Tom, thank you very much. I really appreciate the kind words and the opportunity to present and educate your community. And we always look forward to the reciprocal in a couple of weeks when you're going to be talking to the Chaikin community. So with that, I'd like to turn it back to Joe Bicella, who's going to wrap up the webinar and tell you about our recording and when that can become available, as well as his options training and onboarding sessions. So Joe, thanks very much, and why don't you wrap it up for the folks?
All right, great. Thank you so much, Mark. And thank you, Tom, as well, for your time this afternoon and for everyone for sticking around. So, of course, if you do take advantage of Mark's offer, you can see the order page on your screen here. You can access this in the upper left-hand corner. Just go ahead and take a look at the chat window. Again, you will see the link to chaikinanalytics.com/profits with Mark's discount code automatically applied to $300 off of your annual subscription price if you do subscribe before midnight tonight. Now, as Tom was just saying, education is a very big piece of what makes our subscribers successful. So the first thing that we'll do once we get you in the door is to have you attend one of our onboard sessions. This is a great way to become familiar with our program, great walkthrough for an understanding of how you can find other options opportunities, other earnings opportunities, anything along the lines that we can help you with when it comes to our stock analysis. So again, everything will start here once we get you on an onboard session. With that in mind, as Mark mentioned, we did record today's session, and we'll be emailing this out to everybody who has attended. So if you did join late, no worries at all. We'll have this sent out to you tomorrow morning. So in the meantime, we want to thank everybody for spending time with us today. We all hope you have a pleasant evening, and we will see you tomorrow.